To tell us more about what's been making headlines in finance and economic news this week, we're joined by Suzanne Haddan, Managing Director of BFG Financial Services. Suzanne, thanks for being here.
Good morning.
Now, is the market hitting all-time record super-duper highs?
I know, it's rather exciting. The US market hit another high last night, up over 1.5% for the week on the excitement of potential rate cuts, apparently.
What about here?
Well, we're flirting with our highs from October 2007.
We were meant to get a high this week, though.
We were, and see, they just don't do what we expect, do they? So it was down about 0.6%, but that's after a great 6 months. So let's settle down for a while because it's mainly about the interest rate stories at this point, I think.
It certainly is. How the Aussie dollar is doing, given that the commodities are doing pretty well too.
Well, despite the best efforts of the Reserve Bank by dropping our interest rates and hoping that US dollar doesn't empower ours to go up again, it has gone up, which is great for your overseas trip, not so good for the exporters. So we're expecting it might hover over the 70 cents for a while because we don't operate in a silo. What happens in the world, particularly the US, affects our Aussie dollar and their rates are expected to drop. So once again, we look a little more attractive. Plus, of course, our iron ore prices are well up.
Also, there's nothing really left that the Reserve Bank in Australia can do, really, is there? I mean, how low can you go? Once you're down at nothing, then you're at nothing.
You'd make them very concerned this morning, Josh, but yes, they are down at 1%, so it's a bit limiting. But we spoke about quantitative easing, but hopefully they won't come to that where they print the money.
Yeah,
but,
yes. I like quantitative easing. It's such a nice euphemism. Just printing more money.
Monopoly money. Let's just get it all out there.
Exactly. So who benefits and who doesn't benefit from the dollar being above 70 cents? I know that I'm sitting pretty because I've still got big loans that are denominated in US dollars that I'm paying off. So every time it ticks down by about 1 cent, my costs go up.
Yes, Josh's shout.
So,
Certainly what will help, people tend to be exposed to overseas investments generally via their superannuation. So when you have money invested overseas and our dollar, it can improve your investments from there. So.
We want to stick with the superannuation story here, and there is a discussion of perhaps raising compulsory superannuation in order to benefit the retirement age, of course. Would you agree that this is the time, particularly now when wages are still really low?
Great reports from the Grattan Institute to get the discussion started. The issue is that what we want to see is more people being self-funded, and that is the outcome of raising the compulsory superannuation to 12%. But you don't get visited by the income fairy. The money has to come from somewhere. And so they are correct that there may be some issue around your earnings if employers have to put more into superannuation. But we look at last year, 2018, the age to get the pension was 66. And less than half are now on the age pension. So the superannuation rules are working. You need to reduce the burden of the age pension on future generations. I think that's really important because we do have this bubble of ageing moving up and we're going to have less taxpayers to meet the bill. So let's encourage more people to get self-funded, but it will not be without costs.
Some of the articles this week were saying that, look, actually, over the course of your lifetime, it's worse to be putting lots of money into superannuation, that you actually end up earning less. I suppose there's an opportunity cost about the things that you would have been able to do with that 9.5% or 12% of your income that's currently being sequestered into superannuation. But I sort of scratched my head and said, isn't that the point of superannuation, kind of? That you have less money so that then you don't starve when you're 80 years old?
Spot on. It's sacrificing now to protect yourself when you don't want to or cannot work. I think the modelling, as good as it was, didn't take into account other benefits you get if your income was lower, more childcare rebates, more tax offsets, support in other ways, more family tax benefits. So it's not as simple, we're going to lose $30,000 over our lifetime by doing extra super. It's much more complex than that.
We're living longer. Should we be retiring later?
I think that's an inevitable trend. We've already got the pension age going up to 67. In the next few years, and I would expect that to increase. It was never intended for people to be on the age pension for like 30 years, as great as that is that we've got to that point.
Another issue that was really talked about this week too was the deeming rates, and there was a concern that if you lower the deeming rates, you'll get a lot more pensioners on welfare as well. Is that something that Australia can afford?
So there's a couple of elements there. The deeming rate, interestingly, and I think the government's worried about this, is not just about the age pension. We use the deeming rate to determine aged care income tested fees and other entitlements. So
Just explain the deeming rate.
So the deeming rate, what happens is you have a pool of money, maybe in your savings account, some shares, some other investments. It doesn't matter what that money actually earns. It's deemed to earn up to 3.25%. There's a lower level 1.75 for a small amount, then 3.25%.
And this is just sort of how the government calculates their assumptions about what money is coming into your pocket.
Correct. And it's to encourage you to hopefully earn more than the 3.25%. But as you know, it's very difficult to get 3.25% on your term deposits and cash. And it'll be the people with the lower amount of savings who are most affected with that deeming rate being so high.
Even if you're in a term deposit with $100,000, I don't think you get 3.25%.
Nowhere near it.
Yeah.
You'd be in the twos, and that even if you're lucky, you'd be in the twos. And the other point is, with the age pension, once you've got above the lower levels to get the full pension, the asset test is what costs you a lot more. If you're 10% over on the asset test versus 10% over on the income test for the age pension, it'll affect you nearly 8 times more, a loss of pension under the asset test.
There was also a discussion this week about means testing households as well. And property should be included
Including
in
the
this
family
as well.
home.
Yeah,
and
exactly.
Determining how
It's
well.
a very confronting conversation.
It is.
The issue is your home is your home. And whether you've got a 3-bedroom bungalow in Sydney or whether it's at Wagga Wagga, it still is your home. It's the land that's the extra value. And I think it's very problematic to count the market value of those properties. If you've raised your family, been in that area for 40 years, that's where you want to spend your older years. I think it's much more of an issue about those that are renting, because the amount of rent assistance they receive is quite low, and that's where you have real poverty in retirements, when you don't own your own home.
There are countries in the world like the United States where a significant proportion of state revenue comes from property taxes, and that's assessed on the basis of the current market value of your home. So that they don't care if you bought it for $200,000 in 1970. If it's currently worth $5 million, then you've got to pay the tax on the $5 million. I could imagine that case being made here.
Yeah.
Well, in some cases, like in Canberra, there's a certain element of that already in place. I mean, in New South Wales and other states, we have lands tax over certain values, and we have that dreadful stamp duty, which is such an inefficient tax. So whether we should be changing to the US experience where you pay something regularly over every year rather than a transaction when you sell a property, buy a property and have to pay, thousands and thousands of dollars.
But of course, you can imagine the tabloid headlines about the grandma who's been living in this house for 50 years and all of a sudden she has to pay a lot of money or be threatened with moving out of her home.
Yeah.
It's a very difficult conversation to have.
True, but there are other ways to help people who want to stay in their home. They might be elderly. The new pension loan scheme enables you to borrow from the government against your home and get a higher income stream coming in. Yes, you have to pay interest, 5.25%, but those sorts of strategies can help you stay in your home but not so much rely on the public purse to fund your lifestyle.
Suzanne, great to talk to you. Thanks for being here.
Thank you.
That's Suzanne Haddan.